Happy New Year and welcome to the first episode of 2024. We have two exciting topics to go through with you today. The first being, of course, that the December 2023 stats are out, and we're going to talk about how the year ended and, of course, how it sets us up for 2024. And speaking of that, well, this episode is also all about our predictions for what's going to happen in 2024, both with the economic drivers that shape what happens in the real estate market. And then we will get into what we do think is going to happen within the real estate market and the numbers there. We are obviously entering into a very different year than 2023 was. And although there are a lot of headwinds, at the same time, there's also a lot of optimism peeking through right now, especially within the real estate sentiment market. We're going to go through our thoughts on how we think it's all going to pan out this year. So let's get right into it. Off the top, we are talking December 2023 stats. And as always, we start with the sales volumes, kind of an indicator of the health of the marketplace. And December, typically a slow month, no surprise here. We ended at 1,345 odd sales. And when we look to last year, it's only about a 3% increase. We actually sold more homes this December than last year. But my goodness, when you pull back, it is very slow when we average it out by 10 years, about 36% lower sales volume than the 10-year seasonal average. So it's quite a bit. And of course, when we look at the sales for the entire year combined, about 23% lower than that 10-year average. Unquestionably a slow year. You felt this if you were a buyer, you felt this if you were a seller. And the main reason, of course, that it was slow, we've talked about it a lot, but just as a quick reminder, we saw these multi-decade high level of interest rates, and that really just put the whole market on a freeze. And we'll talk about how these rates are going to affect next year's sales volumes, but that's how 2023 wrapped up for sales volume.
Yeah, I also think, Dan, we increased from December of last year primarily because, we were going through a crazy rate hike cycle at that time. And nobody knew when or where that would stop. So now I think we're much more in a holding pattern. So I guess we'll see if that continues to trend upwards into the new year, which I think it will. Looking at new listings for December, 1,327. It's a 10% increase compared to December of last year, but still well below the 10-year seasonal average at 22.7%. So it's last year's listings were 10.5% below the region's 10-year total annual average. So definitely slower for sure, as I kind of mentioned, and I think new listings was reflected in that as well.
Slow and low. That was kind of the tempo of 2023 and the theme. And it was also reflected in inventory, which ended up the year at like 7,600 units. Now, this is a 43% drop month over month, and that's dramatic, but dramatic even for December, right? Obviously, people definitely delist their properties at the very end of the year, super common, but we saw quite a few or an increased level of that delisting this month. But do expect those to start coming back on, obviously in January, but definitely in February and March. So year over year, almost verbatim, it was only like 70 more units than where we were last year for inventory. And here's an interesting stat. So historically, when we see December inventories this low, the following year is ultimately, or historically, typically a bull market. So 4 of the past 5 years that had December inventory this low resulted in a really big increase in property prices the following year. That was 2016, 2017, not 2018, similar inventory, but a downward year in prices, 2021 and 2022. So, does history repeat itself? We'll find out, but we're setting ourselves up for what historically has been an appreciated bull run in the following year.
And I think it will. I think it will be far more optimistic than it has been. And I think sales will reflect that. I think inventory will reflect that as well. Speaking to sales to active ratio, still hovering around that 18%. It's up a little bit, 1.7% from the month below. However, a bit of anomaly with such low sales volume that things seem to be maintaining. But, we never entered that buyer's market, that official buyer's market this year, which was ultimately extremely surprising. With that said, if we break it down by asset class, we're 12% for detached homes. This has been the same now for 4 months. So I'm wondering if we're hitting the bottom in terms of certainly trending here at the bottom. Probably going to head up from here, especially as we head towards the spring market. 22% for townhomes, which very similar again, and 22% for apartments, which is actually up 4%, showing some of that consumer sentiment starting to hit, on the rise a little bit here in the more affordable class.
Now over to prices, which are definitely interesting right now, and keep these numbers in mind because it does set us up for our predictions for what's happening next year. So the year washed out with the HPI home price at $1,168,700. That was it. Big number still. But this was down about $16,400 month over month. And that's a almost 1.5% decrease in 1 month. And it's also the fifth month in a row of price drops, down about 3.6% since that recent peak of that cycle. But what's notable here is that the rate of price lowering is accelerating. It was about 1.1% last month, 1.4% this. We are now back to April prices, April of 2023, and a total of about a $42,000 reduction since our cycle high, which was seen back in July this year. If we go back even further and we look at the all-time high price that was experienced in sort of March, April of 2021, these home prices by HPI are down about $94,000 or 8%. So let's go back a bit further for fun. Pre-COVID prices were still sitting about 25% higher than we were pre-COVID. Expanding on this a bit more, let's talk about the median price, which is now at $940,000 and experienced a $30,000 drop just last month. And average is $1.242 million with a $42,000 drop last month. These are some of the largest drops of the year we've seen in month-over-month prices. So we are definitely seeing maybe the rate hikes washing through now to a point where they're really taking hold on property prices. As we know, we're only off 8% from the all-time high. Yet don't forget, purchasing power based on current rates is down 25-30%. So we have not seen prices equate to buying power. I don't even think we will, but we'll get into that in our predictions. But either way, we are entering 2024 with 5 months of a downward market with price deceleration increasing in speed.
Yeah, and I think days on market's reflecting that too, as we continue to climb upwards, hitting 24 now, and that's up 4 days from the prior month. So things, again, compounded by a typically slower time in the marketplace. But I think there's also a lot of anticipation in terms of what's going to happen in the spring market. Dan, you just mentioned people delisting in December. Many of our clients have done that, not to have stale listings, and decided to move for the spring market, right? So I think we're seeing some of that play out in the days on market. We're seeing buyers still sitting, waiting to see what the Bank of Canada has in store for 2024.
Perfect. That wraps up the end of 2023 and the stats that happened there. So let's get into our 2024 predictions. And if you watched last week's episode, or if you haven't yet, we did our recap of what our 2023 predictions were. And it was, a very interesting outcome. I think we were right about 42% of the time. Very difficult, of course, to predict further than 3 weeks, 3 months, maybe. 12 months is almost strictly for entertainment value. But, we certainly try to be as accurate as possible. And when we're right, we're right. And when we're wrong, well, it can be dramatic. But let's do this again. It's a fun exercise. And we do start with the economic drivers, right? What are the drivers that are going to affect what happens in real estate, both obviously nationally, but most importantly here in GVRD, where we focus our attention. The first thing we're going to discuss is the R word, recession. Will we see one in 2024? And I guess we have to define recession, or who is defining this recession? Because, of course, if we look at per capita GDP numbers, for example, we're already well within a recession, but the government hasn't called it yet because they don't look at per capita, which we think they should. Regardless, our prediction will be based on, I think mine at least will be based on what the government is going to call a recession. And so I think in 2024, yes, we will see a recession as called by the government. It will be shallow, meaning it will not be a deep or severe recession, and it will last about 2 quarters. Of course, we won't hear about this until probably the end of the year when the government looks back and says, oh, yes, we've looked at the numbers now that the dust has settled, and we were, in fact, in a recession for half of 2024. That's my recession guess.
Well, mine's not all that dissimilar from yours, Dan. I mean, a technical recession would be 2 straight quarters of a shrinking economy or negative growth. The third quarter of Canada's economy shrank at 1.1%, meaning we're already only 1 quarter away from an official technical recession, which I think will take place here in 2024. However, I do think at this point it'll be shallow, much like you said. And I think it largely depends on what happens with quantitative easing in 2024 and how the government decides to stimulate the economy. And a lot also will be based on the run up to the U.S. presidential election as well. So a lot of things there that will likely have influence over whether we stay in a subdued recession or a deeper recession. We'll see. But either way, I think a formal recession is on the books for 2024, though I doubt it will be a long and deep one. Speaking of which, and one thing that will definitely help whether or not we stay in a recession will be our population growth. I do think looking at population growth over the last couple of years, it has been by an order of magnitude that has seemed unreasonable and somewhat at times irresponsible. A lot of inviting people over for dinner with nothing on the dinner plate for them, so to speak. I do think population growth is a big way that the government is trying to soften the blow when it comes to a recession by having more taxable dollars in the system. However, if the job market continues to go at the current pace it's going and people don't have reasons to come like they did, then I suspect we'll see lower numbers. I think we're going to be quite a bit lower. I think it'll be somewhere around 750,000 in terms of population growth. I think this is the case because it's going to be under the microscope a lot more than it has been in the past.
Yeah, and for reference here, the last measurement came in at about 1.2 million, and so 2023 will wash out around 1.3 million new people into the country, so a huge number. So Ryan, you're saying 750. Mine, yeah, I still think it's going to be above that. I think we're going to see 800,000 plus. That's my number, but it will be obviously about 500,000 less than the previous year based on the fact there are less jobs. We may be throwing out the R word there to the rest of the world to say that, we're not in a financially strong position. So, why come here? And of course, there's going to be a huge pullback on the amount of these foreign students that are coming in because I think the backlash is well underway here. We know a lot of these for-profit schools are abusing that system. We know that they've already the governments have increased the requirements, financial requirements for students coming into the country and what they need. So I think that'll be a big segment of the market that reduces the overall population growth. So that's the number. Moving then into our jobs market prediction. Today, the unemployment rate sits at 5.8%, bringing us almost parallel or exactly where we were pre-COVID. The stresses in businesses right now are plentiful, and that's very much seen in their arrears rates, their insolvency rates, and the sheer volume of debt that they've taken on and are having trouble paying. So yes, I'm firmly of the belief the unemployment rate will increase this year. I feel it'll end 2024 6.5% plus.
But it doesn't surprise me that we don't see things too far or too dissimilar. I was in the same sort of bracket at 6 to 6.5%. But again, I think that's really depends on the kind of recession that we find ourselves in. If we find ourselves in a much deeper recession, I could see that climbing to 7.5%, maybe even 8% before coming back down. If we stay in a shallow recession, 6.3 to 6.5%, I think is where we'll peak. And then I think things will turn around. However, a lot remains to be seen as to how that will unfold. And speaking of one of the major drivers of the job market, the major drivers of our economy here will be the inflation rate. At the time of recording now, we're sitting at around 3.1%. We know we've gone through this insane battle to get inflation to where it's at. Will it remain there? We'll see. I think inflation is going to normalize around between 2.5% and 3% for the year 2024. I think actually there's going to be a need to look and potentially adjust the target band that they've been talking about. I think 2% is going to remain ideal, but I think it'll be very difficult, causing an excruciatingly large amount of pain to stay there after pumping so much new capital, so much more money, so many more people, purchasing power, all these things into the economy. I think it'll be hard to maintain a 2% inflation. I think it'll be more like 2.5%, 3%.
Yeah, and just so everybody knows, Ryan and I both made our predictions without sharing them with each other. So we are hearing each other's for the first time while we're recording this live here. So very interesting to see when they do align, and I'm sure there'll be a number that don't. But inflation, interestingly, yeah, I'm very similar. I said we will likely bounce up and down, 1% swing either way, ultimately settling at the end of the year right around 2.9%. A lot of the factors that drove inflation rates so high over the last couple of years are now gone, right? All the QE has stopped, and now we're moved into QT. And of course, inflation is starting to get under control as well. So I think, yeah, a little bit more of a normal, stable year as well. Again, expected to balance between, let's call it 2 and 4% total, but again, washing out right around the middle at 2.9%. Now, what does that do to the Bank of Canada overnight rates? A ton of people obviously paying attention to this. I think more people are focused on interest rates now than they've probably been in 20 years, and rightfully so, because they're so directly affected by them. At the time of recording today, the overnight rate at the Bank of Canada is 5%. We've seen these predictions from all levels of, banks and economists, and even some of the central banks, down south. And do keep in mind, one of the things that the Bank of Canada wants to be very cautious of is if and when they do start cutting rates, that there is not that exuberance and excessive spending again. So it'll be very interesting because we feel the sentiment increasing in the real estate space. And so if we do see a rate cut, we do see all these buyers and sellers come off the sidelines, and we do see prices start going up again, there is absolutely nothing stopping the BOC from holding or even increasing again. So lots of forces pulling these rates in both ways. Ultimately, I'm kind of going with the markets now, but I think we're going to end up with 3 cuts, a quarter point each, ending the year at 4.25% overnight rate.
I literally have between 4 and 4.25%. I do think that, much like you've talked about, Dan, when it comes to the overnight rate, it's a very sensitive topic right now because we have, like we mentioned in a previous episode, a 5% interest rate that's doing the same sort of damage that a 13% interest rate used to do. And this is because of our debt to GDP levels. You have to remember, if you go back a couple decades, debt to GDP was sitting at 89, 90%. Fast forward to where we are today, we're one of the highest in the G7 at 170 plus percent. So it only takes a few bips going up to create a whole world of havoc, which is what we've seen. So by that sort of understanding, going back the other way, we have to be very careful, and the Bank of Canada will be slow to release quantitative easing this time round. I don't think we'll see an elevator to the basement. I think it will be 0.25 cuts, somewhere between 0.75 and 1%. And again, that really depends on our GDP output, our job numbers, and what forward-looking markets are considering at the time. And speaking of which, those forward-looking markets, banks they're the ones who will be driving a lot of this. So looking at mortgage rates here, I broke it down between 2. I think that the banks will begin to play ball. They will be slower than the Bank of Canada. I do think by the end of the year, we could see insured rates at not only with a 4, but potentially even a 3.94% insured rate. We'll see. I do think most mortgage rates, 5-year fixed mortgage rates, will sit around 4.3, 4.5%, as long as the interest rates drop the way we are predicting.
I'm quite similar, and let's just remind everybody too. Today, fixed rates are in the mid fives, and variables are in the low sixes. Obviously, in lockstep with my BOC predictions, this ends the year having the fixed rates in the mid to high fours. I didn't do insured separately. Yes, understandably, those would be a little bit less. But variable, you can expect that to be in the low fives as well. So a bit of reprieve for all the mortgage holders out there, or people looking to buy. Obviously, it will be lower than today, prediction-wise, and we'll see where it washes out. But I do believe it will come down for both mortgage types by the end of the year. One big thing that's happened a lot in 2023, thanks to the new people in government, is, of course, all these new housing policies. We saw GST stripped out of rental buildings for those looking to build those. We saw, obviously, the Plex plan about to come into Vancouver when it was then usurped by a very similar plan for the entire province of BC. That comes into effect by June 30th of this year, taking all single-family homes province-wide to be able to build anywhere from 4 to 8 plus units, depending on location, near transit, etc. So sweeping change, massive change. And this is all because housing is all the rage right now. We know we're in a housing crisis. We know we have insane population growth, and we know we've got developers pulling back. So the math currently doesn't equate for being able to house all the people that are coming into the country, let alone the ones that are here today. So we wanted to predict what type of policies may come into effect in 2024. I'm just going with one. I want to keep it simple and focused, knowing that housing is everything, and knowing that we've got government in power that is pro-housing, and they've made all these policy changes to help stimulate supply. The next step to truly impact the amount of housing here is to incentivize builders further. That can come in a few ways, but obviously with approximately 1/3 of every new build going to taxes, reducing that would be the easiest one there, outside of streamlining the processes and, of course, incentivizing it in other manners. Removing GST at all, obviously that's still taxes, but maybe there's builder financial benefits that are thrown at them, more incentives, just to say, okay, cool, here's a 0% construction loan, for example. I think somewhere along those lines is what we're going to see policy-wise in 2024.
So yeah, with respect to policies here, I mean, like Dan said, we've seen a huge amount of policy change over the last year. I think 2024 will be a lot about formalizing and implementing the policies that they've put on the table. So from the municipal level here, I think the Plex plan, much like we talked about, will be the major focus here. And I think at a municipal level, I think, if we could provide financial incentives, that'll be one thing. But the other thing that really impacts builders will be speed. So the ability for municipalities in the province effectively to create an environment where it doesn't take 18 months to get permits. So if it can take 6 to 12 months to get permits, that would increase the viability of these projects, because we wouldn't have to hold on to the properties for that much longer, passing on those higher costs. So while the policies, I think, that have been suggested and put on the table, I think the Plex plan is a fabulous idea. I think in order to take advantage of that, the next step for policy will be implementing speed, implementing the rate of change. That has to happen. If we do that, I think we take advantage of the policies that have been laid out. And also, I think the feds are currently looking at templating this post-war sort of design of making homes, building homes faster. But again, the whole premise will be around speed. Speed is what we need now. We've got, I think, good plans in place. Now we need to implement and execute. And I think that'll have, eventually, I think that'll have an impact on sales volumes. However, for 2024, I don't think enough of these policy changes will filter through for us to see any kind of real sales volume change by way of policy. So by looking at 2024, I think, when it compares to the 10-year average, I think we'll be still down. I think we'll be 10 to 14% below the 10-year average. Just at the time of recording, just so this is fresh for everybody, we're currently 24% below the 10-year average. So I think that with the sense of renewed optimism, we get some rate cuts, we end a recession, and by the latter half of 2024, I think we'll start to see this market begin to improve dramatically.
Okay, so we have completed now the economic drivers, and we are into what we think is going to happen with the real estate numbers here in Vancouver. For sales volumes, I took a slightly different approach, and I was simply comparing year over year difference. Absolutely think we are going to see an increase in volume this year. I think to the tune of a 15% increase over 2023, based largely again on sentiment, right? Even if homes aren't necessarily more affordable, if people think the market is trending in their favor, they're going to come off the sidelines. We're literally seeing it in the first 2-3 days of January here. It is palpable how much people's focus on real estate has shifted already this year. And so I think easily 15% plus volume increase will be realized in 2024. Part of that will be seen in the sales to active listings ratio. As Ryan alluded to or touched on earlier in this episode, when we look at last year, the SA ratio never entered a buyer's market. It's very rare that it does. I did a tweet, I think last year, showing the last 20 years of Vancouver real estate, and buyer's markets were only sustained something like 8% of the time over a 20-year period. It's a unicorn in our marketplace. And so what's it going to do in 2024? My prediction was that we are going to see half of the year in a balanced market where we are today, and the other half of the year will be in a seller's market, right? The SA ratio, it doesn't really just ever go flat. It goes up, it goes down. It usually peaks in spring and fall. Either way, expect half the year in sellers, half the year balanced.
Yeah, I'm Dan, very, very similar. Ultimately, I believe the first half of the year will be in a partial balance market. It'll flow between the two, depending on the Bank of Canada, depending on rates, depending on a number of elements here. But I do think as we settle into 2024, and I think as we move into the latter half, I think we'll see a shallow seller's market. Somewhere between 21 and 24% is kind of where I think we'll end the year. So we'll see. And again, though, so much of that will depend on inventory. Inventory is the story. How many times have we said that? Looking at 2024, actually, before we get into 2024, looking at 2023, and considering, interest rate rises, the whole purpose of an interest rate increase is to slow down the economy to allow supply to come back to market. But what happened during this interest rate cycle was that many developers actually got taken out, or they're no longer bringing those projects to market. They were delayed, and they will wait for far better times to do so if they survive. And that will have a very real and clear, I guess, present danger on the amount of units that could be brought to market as well. So while I'm looking at inventory, I still think we're going to struggle with inventory because I don't think much was fixed in the last year. A lot of new policy changes were driving that, but I don't think a lot of actual change will take place because this will take years to come to fruition. This will take a long time. So, I think our inventory issues will remain for the next 2 to 3 years. I think, the implementation of Plex plans, the time it takes to build units, all that sort of stuff. So, looking at inventory, I don't think we're going to change too much from where we were this year, to be quite honest with you, Dan.
Okay. Yeah, I largely agree. It will be a tight year again this year, not quite so much as last year as people are coming off the market. But what we're going to largely see is all these people that now list, the demand is there as well. So you're going to see all these listings that come to market get absorbed quite quickly. I'm going to predict that inventory is going to average an increase of around 10% throughout the year. And when the year washes out and we look back at all the dot points here, it won't ever cross 13,000 units total. So keep in mind, in last year, we never crossed 12,000 total. This year, there will be more, a couple months in the 12s, but I don't think we'll crack the 13K mark in total active inventory at any time.
I'm sorry, I realized I didn't give you my number, which it was 12,000. That's what I just don't think per month will. I'd love to see us get higher than that, but based on what we just saw through an extremely difficult interest rate environment, I'm surprised we didn't get more units. But it also goes to show when you have a market that's only got 50% of mortgages applied to the property in the marketplace, it's going to take something else to bring those markets something else to bring those properties to market.
And similar to resale, obviously pre-sale market, it kind of follows it. So if we're going to see a positive, if you will, or an upward trending resale market, well, pre-sale will follow that. And Ryan just touched on the fact that, it was a brutal year for developers last year. Some folded, many pulled back projects that they had planned to release in 2023 to hold for greener pastures, which ultimately I think we're going to start to see this year. So I had some predictions here. We're definitely going to see an increase in the amount of units released to the marketplace over last year, to the tune of 20% more units. And I also predict an absorption rate that will average 30% every single month when it all washes out by the end of the year.
My absorption rate was right on there too, Dan. I'm sitting at 35%. I still think I think it'll be a little bit higher because I think that they'll still be seen as a bit more of an attractive option under the current rate scenario, so long as developers do bring the projects to market. With that, I think we'll see a little bit higher level of absorption as people can lock down a unit and take advantage of what will be lower interest rate environment in the coming years. So I think that'll be a big part of it. And much to your, I'm right on par at about another 10% increase in terms of units brought to market. So with that being said, let's take a look at rental rates. Rental rates exploded this year, something that I don't think either of us could have predicted. And I do really hope that as we move forward, that this really begins to moderate. In fact, I think we're on that pace now. I think we'll see a slight increase within sort of the same target band, about 2.5% to 4%. So similar to the inflation rate, I think is what we'll see rents increase by. It won't be a linear, straight up environment. I think it'll bounce around a little bit, but I think it'll end somewhere between 2.5% and 4% by the end of the year.
Okay, I've got a different prediction here. Obviously, rental rates are coming down right now, and they've been trending down for around 3 months, and that's fantastic because they've been way too high in our city for too long here. But when I look at the forecasts of how many people are coming into the country versus how many homes are being built and, of course, completed this year, to me, all I see is further upward pressure on rental rates, ending the year 8% plus higher. I think it's going to be another tough year for rental rates based surely on the simple supply and demand. Not something I'm comfortable saying, but I think that's ultimately where the realities may sit. So we will see there.
What we saw this year, Dan, and I don't think either of us could have predicted 8% in this market, right? And here we are. So.
And for those who aren't renting and feel like buying homes over $7 million, we have been tracking the luxury market of it here. And last year, we saw a total of 86 homes, $7 million and higher sell in the greater Vancouver area, including the highest MLS price ever at $32 million up in Whistler. Is that going to continue? Yes, I strongly believe it is. I think a lot of big money is still coming into our city here. It is still in demand. It is still a safe haven, and the product is here as well, and people do like it. So I think that number is going to increase. I think there's an extreme amount of wealth that wants to place money in real estate, in beautiful real estate here. That 86 is going to increase to Gretzky's number. We're going to see 99 plus units in 2024 over 7 million sell.
I'm really not that far off, Dan. I agree with you. I think smart money is going to look at the last year and recognize what a resilient marketplace Vancouver has shown. and it has the macro and microeconomic factors to support that. And I think looking forward, I think we'll end the year at 91 luxury sales over 7 million. So really not a lot that separates us in this prediction here. And then having a look at that, I think considering all the things we've just talked about, the one thing I think people are most interested in is price. And for the sake of the projection here, we will look at the HPI to begin with, and then we'll split it up into different categories here. So based on everything that I've looked at for 2024, I do think we're going to end the year 5.5 to 6% up from where we are today, with most of that coming in the latter half of the year. I think the first half of the year will be a lot of testing the market. We'll see how buyers and sellers do in the spring market. That'll be a palpable testing ground for the balance of the year. And I think that'll be the testing ground for the Bank of Canada as well. Assuming that the Bank of Canada continues to drop their rates and purchasing power increases, I think we'll see a lot of people who had plans in 2023 that put them off move into 2024. And I do think we'll start to see higher levels of activity resulting in a 5.5 to 6% gain in prices.
Interesting. Okay. Yeah, I guess maybe we've learned our lesson, because if you didn't listen to our predictions in 2023, both Ryan and I expected a downward year in pricing last year, and we were both spanked as ultimately prices ended up 5% plus across the lower mainland here. And maybe we sharpen the pencils a bit. We'll see. But myself, yeah, pretty similar prediction. Q1, I think prices are going to still get hammered. They're going to go down a few more points, then trend back upwards, ultimately landing at 4% positive on the year.
Should we break it down by asset class here, Dan?
Let's do it. So let's start with detached. This is the property type I am most bullish on, largely because these are not being built anymore. The detached home is becoming more and more rare, and there's going to be a big rush to a lot of lots as well to build these flex plans. There can be a tremendous amount of money made here, especially if we see over a 1.0 FSR when the ink dries here on the municipal plan. And so people are going to be going after them. And so every home, every detached that's torn down is torn down forever because they're going to be turned into 4, 5, 6, 8 plus units here. So detached homes are going to be the darling of 2024, going up 8+% by the year's end.
I was right behind you, and right for the exact same reasons as you just mentioned. I came up with 7% on the year. And I think, generally speaking, it could be plus, or I don't think it'll be much lower than that, but it could be even higher. So I'm saying 7% as a conservative number, but I do think it could reach as high as 9%. And then looking at townhouses here, or the attached sector, I think will do a little bit less, mostly because now I think some of these townhomes are going to compete, although not right away in 2024. As we, 2 to 4 years from now, however, townhouses will compete with the Plex plans, and we should see a more distributed flow in terms of appreciation there. However, for next year, I still think townhouses will perform strong, as people will want to stay in the neighborhoods that are within, that 15 to 30 minute band of the downtown core as much as they can for Vancouver. So I think we'll see townhouses up 6% next year.
Nice prediction. I'm a little more bearish than you. I do think these are going to be a very sought after property type. And I also think there's going to be a lot of these coming to market. So they're going to, kind of be a little bit more of a baseline. Sure. Similar, Q1 probably go down, end up the year 3% was my vision for townhomes. So yes, they will go up again, just not as extreme as I think detached will, which takes us to condos now. And I've got a slightly different view on condos. Obviously, home prices in Vancouver, extremely high still. Condos will always have the highest amount of volumes, and therefore, they really kind of, they're not a leader. A lot of people think detached is still the leader, but when it comes to sheer volumes, this really speaks to a lot of the movement that we can expect in 2024. And based on sheer affordability, people are trying to buy what they can, and condos typically are the entry point these days. They're the entry level home for many. So I think condos are going to get quite a bit of attention this year. Downtown, I think, is going to continue to suffer. But as we are talking about the Lower Mainland as a whole, condos are going to ultimately wrap up 5% positive on the year.
I'm a little bit more bullish. I believe in, for the sole purpose of affordability was where a lot of, and availability was where my prediction came from here. And I'm up at 6 to 6.5% for condos. So very similar number, just a point and a half higher from where you are, Dan, and that's just my optimistic nature. With that being said, let's look at the top 5 markets. This is what we ended with last year. I've got my top 5 here, and I'll start. I'll lay out my 5 and the reasons for them, and then Dan, maybe we'll look at yours. So I'm going again with Squamish. Squamish was had a huge bump last year. It went up 11%. And I think that Squamish will continue this trend, mostly because it's an alternative to places like Langley and Surrey, but it also will have the residual effects of all the money coming into Whistler, which we know is tremendous. I mean, the highest MLS sale of all time took place there at 32 million this year. I think we're going to see more money continue to flow in that direction, and just by sheer proximity, Squamish will benefit tremendously from that. You're also going to have Whistler right behind it. Whistler jumped 7.8% last year. I think it'll do something similar again this year for a lot of the reasons I just spoke to. And then I think as we look towards some of the more affordable markets to the east, looking at Coquitlam, I think will be a very strong market in 2024 based on affordability. It's also where we're seeing a lot of new condos coming to market. So I think there's going to be some interest there. New Westminster will continue to perform based on its light rapid transit. It can get downtown within 30 minutes. I think we'll continue to see the revitalization of New West. And for the same reason, Port Moody. Port Moody, I think, will outperform. It is 40 minutes outside of the downtown core. It has light rapid transit connections both to Coquitlam, but also back the other way. And I think it will become its own hub at some point. But for now, I think it maintains as a very great alternative for people looking for condos and single family homes, as that part of our city has some beautiful outdoor nature spots too. So I think it'll remain popular and outperform the GVRD.
Fantastic predictions. I'm going to agree with all of them, but we did limit ourselves to 5. I'll share that both Squamish and Whistler were on my list as well. New West was last year in a winner, but I had other ones. Port Moody, love the neighborhood, a great one. Coquitlam is interesting because I had Port Coquitlam as one of mine. I've moved a lot of clients into that neighborhood in the last couple of years, and really like the development that's happening there. It's got good affordability, good accessibility, and I believe it will outperform the GVRD average. Let's give them a couple more here. We're actually going to end up with 8, just because this is how we ultimately chose them this year. I'm doubling down on Langley. I think Langley will outperform for a couple of reasons. We are seeing continued infrastructure, of course, the SkyTrain being built into there. And now a lot of these townhomes are going to shoot up, and lots that were planned for townhomes might shoot up and be ultimately high rises now, helping affordability and demand. And it's a nice area. There's a lot to love about Langley. And my last prediction was actually an interesting one. Kitsilano, the blue chip stock of GVRD real estate, actually took a little bit of a hit in 2023. So I think it's going to rebound. And I think it will be forever a desired area. And I think there's some nice developments going in there that will draw some big money, because these pre-sales are at mid 2000s a foot kind of thing. And there's some beautiful houses being built there as well. So overall, I think Kits will just slightly outperform GVRD as well. That is it. Those are them. They are cemented. They are official. Come back to us in 12 months and laugh, cry, applaud, whatever it's going to be here. But thanks for joining us on today's episode. We really do enjoy making these predictions and, of course, course correcting every single week as we go through the year, bringing you all the fundamentals that have changed and all the data that's changed, because it's a very fast moving market. It's fascinating to see Vancouver real estate change as much as it does year over year. It's never flat. It's never boring. There's always something to talk about. Week after week, we think, oh gosh, are we going to find enough interesting elements to discuss? And sure enough, we're actually cutting back on some of the things we could talk about because it just is so much. So Ryan, why don't you leave us with some parting words for today's episode?
Yeah, I think looking at any kind of prediction, trying to see into the future is very difficult, and take this all with a grain of salt. It's based on the information that we have currently, right? It's a ceteris paribus kind of look at the economic world, understanding that all things remaining the way they are, or remaining at least within a band of accuracy that we can predict. Outside of major swings in the economy, huge policy changes, government changes, these are things that we can't see coming. So outside of that, I would love to see a beautiful, stable year in real estate, just one that is relatively boring. I think a lot of Vancouver deserves that. I think a lot of buyers would love to see some stability and less volatility, both up or down. Creating a sense of stability will really bring back a lot of normalization to the marketplace. And I think people can make better decisions with their life. They're planning 5, 10-year, 15-year plans once things stabilize. And so it really should be incumbent upon the municipalities, the province, and the federal government to try and bring us back to a stable environment as best we can, so that people can go about their lives and we don't have to pump this market. We don't have to drop this market. It can stabilize. That would be, I think, the best outcome for 2024.
Fantastic. Great final words. Thank you as always for tuning in. Let's have a wonderful 2024, and we will see you again here next week. Have a great day.